Clients and friends of Frazier Financial Advisors. First of all, happy 4th of July weekend to you and your loved ones. We hope you get to spend time with family and friends. Please see video content we created on the market environment we see today. Please let us know if you'd like to discuss any specifics on your situation. Thank you. We first provide a backdrop of what has occurred the last few months. Secondly, we outline what actions we have been taking on your behalf. Finally, we will look to the future. From China to Italy and Iran, the coronavirus quickly changed the world. Headlines were scary and rapidly evolving. We will never claim to have an expert take on the coronavirus from a healthcare standpoint. However, we do need to have an informed framework for what it means for investors. And if the worst global pandemic in 100 years wasn't enough, we had an oil price war between Saudi Arabia and Russia. This resulted in the biggest drop in oil in almost 3 decades. Energy stocks were dramatically lower. Between the coronavirus and oil price collapse, there was a lot of bad news swirling. Markets are always trying to price in news as quickly as possible. Asian markets reacted first as they were closest to the virus epicenter back in January. You may wonder why markets were not reacting more aggressively to the novel coronavirus back in January and February. At the time, the medical community was still trying to get their arms around the behavior of this new virus. Viruses have flared up in the past, and markets have marched onwards. As the virus unfolded, markets reacted. 2 things became clear in late February. This was not just a China or Asia problem, and the virus is different than previous viruses we have seen in the last couple decades. The global economy was going to take a major hit from social distancing and stay-at-home precautions. It's tempting to think that we should have all known back in February what was going to unfold. This reminds me of the 2008 financial crisis. With hindsight, it is easy to see how the global financial system would suffer so dramatically from a housing market correction. What was unappreciated back then, even by really smart people, was the size and scope of the problem. There are always some that correctly envision the turmoil that is about to unfold. However, that same personality type lends to predicting other calamities that do not come to fruition. There's an old saying that bears make headlines and bulls make money. The U.S. stock market experienced the fastest correction in history. Markets were up or down over 10% a day for a while. Volatility was truly unprecedented and eclipsed levels not seen since the 2008 financial crisis, tech bubble bursting, or even the Great Depression. March 23rd turned out to be the low. In a few minutes, we will discuss our tactics during this correction. First, we would like to highlight our overarching strategy, what we believe is fundamental to investing. Our emotions help us do a lot of good things. They make us terrible investors, especially during periods of volatility. The desire to seek pleasure and avoid pain can be a great thing in daily life, especially for my 2-year-old learning to climb stairs and any other elevated surface he can find. We have all heard buy low, sell high. But why is it so hard to do in the moment? Our emotions are linked to our money. Hiring an objective advisor helps disconnect some of those emotions in the heat of the battle. In March of this year, we saw opportunities that we have not seen since 2009. We will get into some of the details in a bit. If it makes you feel any better, you're not alone. Scientists have documented over 180 cognitive biases. Many of these interfere with our ability to make good investment decisions. These biases cause us to say things like, let's sell now and get back in when things look better. Part of our value to clients is the ability to build a strategy based on experience and not emotions. This helps clients stay invested with confidence. I don't know about you, but things felt pretty stressful back in March. The track down from denial to fear to desperation played out in a variety of ways, not just in the financial markets. Only recently do I see glimmers of hope and relief emerging. As investors, we try to be greedy when others are fearful, and fearful when others are greedy. When low prices and fearful attitudes collide, markets are often at an inflection point. We felt this collision back in March. In February and March, I started to visualize this investment landscape. It was clear in this mental model that there were 3 distinct time periods to be focusing on. The first was the easiest. It was the world as we knew it before COVID-19. The second time period is life as it is today. We are all living with a virus that does not have an effective treatment or vaccine. The valley is represented by a serious drop-off in economic activity. However, the valley means different things for different companies. This valley is benefiting industries like telehealth, cloud computing, grocery stores, and media streaming like Netflix. On the flip side, restaurants, travel, and social gathering industries are struggling to survive. When considering what actions to take back in March, we had to have a framework for what the depth and width of the valley would look like. It was very difficult to precisely know those two pieces of information. However, the incredible stimulus provided by global governments started to build a bridge. Although we are still in the valley, we must think about what the world will look like once we have an effective way to treat the coronavirus. There's no shortage of opinions on what this new normal will look like. Our best guess is that we've accelerated some technical advancements that would have eventually occurred. Corporate travel may be reduced as virtual meetings replace some in-person meetings of the past. This was probably the nail in the coffin for some struggling retailers or other vulnerable businesses. For most sectors, the post-COVID world probably looks a lot like 2019. On the positive side, we're likely to come out of this pandemic with innovations in technology and healthcare. Despite a lot of bad news in the world today, I always look for a silver lining. History tells us that previous healthcare events like the Black Plague of the 1300s led to incredible innovations in societal change. Same with the Boston smallpox outbreak in 1711. SARS in 2003 probably played a role in shaping China's internet companies, including Alibaba, one of the most valuable companies in the world. Years from now, we will look back on this pandemic and identify positive trends that emerged. Microsoft sees tens of millions of new jobs related to digital acceleration. Telehealth has shown tremendous upside. Golfer Nick Watney's Whoop fitness watch detected abnormal respiratory rates while he was sleeping. Otherwise asymptomatic, Nick tested positive for the coronavirus. Wearable healthcare technology is likely a fast-growing industry. So why was March the low? The virus didn't go away. We didn't get an effective treatment or a vaccine. Two major actions helped stabilize the markets and the underlying economy. First, the Federal Reserve, led by Jay Powell. The Fed's announcements in mid-March were not enough to assuage markets. The day after announcing a $1 trillion support plan, markets were down dramatically. Markets declined further. There was growing consensus that the Fed was going to do something big and unprecedented. On March 23rd, they announced these measures. In 2008, for example, the Fed provided $1.4 trillion of support to the markets over a period of 2 years. In 2020, the Fed added almost $3 trillion of support in 3 months. Additional support is planned for the rest of the year. European central banks and the Japanese central bank are also providing trillions of dollars of stimulus to their markets. The second major action was Congress passing the CARES Act, an injection of another $2 trillion into the economy. This was the 1-2 punch that killed the bear market. The US was not alone. Almost every government passed some sort of fiscal stimulus to support their economies. After a 35% decline, markets needed to rebound 55% off their lows to get back to even. Markets have clawed back a fair amount of their losses in just a few months, as stocks are up 41% off of the March 23rd lows. US stocks need to gain about 9% off current levels to get back to all-time highs. It may seem strange that the stock market is climbing while infections, deaths, and hospitalizations are still growing. The stock market is a forward-looking discounting machine. Earnings projections for the year 2021 are more important in the market's eye than daily virus infection rates. The two are related, but not directly linked. Long story short, the stock market is pricing in that we eventually get a vaccine and the global governments will provide enough stimulus to prop up troubled industries and consumers along the way. So what was Frazier Financial doing? We came into 2020 with extra caution. Many of our funds entered 2020 with extra cash. This was not a prediction of any market event. It was the result of strong gains in 2019 and a view that prices were getting a little too high for some assets. Our active managers were buying the whole way down into March and April. You don't see these buys or sells come through in trade confirmations or monthly statements. It's more like a duck swimming across the pond. If you look under the surface, there's a fury of activity paddling away. The extra cash in our funds allowed managers to strategically put to work as prices declined. One of our largest holdings, First Eagle Global, was putting billions of dollars of cash to work on investors' behalf. While every client's portfolio is customized to their needs, we made large buys in March on 2 different occasions. This impacted almost all of our clients. For clients who are in accumulation mode and adding to their portfolios, we adjusted what they were buying in their 401ks. We were working quickly as markets were evolving rapidly. Many clients were able to invest extra cash into their accounts, which has paid off so far. Markets have rebounded quickly, so we sold one of the investments we made back in March. In May, we realized a 25% profit and placed proceeds back into a more cautious stance. Looking into the future, we feel there are 2 time periods we'd like to discuss. One is the near term, the next 12 months. The second being the medium term, 1 to 2 years out. There are a lot of things going on the next 12 months. Virus headlines will be back and forth between infection flare-ups and hopefully positive developments on the therapeutics and vaccine front. It is possible that the virus accelerates and the global economy is dealing with waves of shutdowns and stay-at-home orders. If this is met with monetary and fiscal stimulus, markets can digest the potential bad news on infection accounts. Brexit. Yes, this has been going on since Brits voted to leave the EU back in 2016. A messy exit from the European Union would be bad for both sides, but the risk is still out there. Negotiations will pick up over the next 6 months, which could contribute to volatility in global stocks, especially European stocks. China's political relationship with the US dominated markets before the COVID-19 outbreak. The trade war and political tensions drove a lot of market volatility. The image of protesters here in Hong Kong is actually from 2014 to highlight the ongoing tension between Beijing and Hong Kong. There is a risk that Beijing's interventions in Hong Kong create a major conflict that could draw on American political or military attention. As of now, it seems most likely that mainland China will slowly erode Hong Kong's special status while trying to maintain peace and order. You can count on China being a hot topic in the upcoming US election as populism and anti-globalization sentiments are increasing. The US election will have an impact on market behavior until November. If Democrats take control of the Senate and the White House, Joe Biden's tax plan could be implemented. This plan would raise corporate taxes and individual taxes on higher income households. This would be a negative in the stock market's view. A divided Congress and either Biden or Trump in the White House would likely mean gridlock. The stock market likes less change and uncertainty to deal with. Movements within sectors are common during election cycles. Pharmaceutical and social media companies are easy punching bags. A Trump re-election is probably better for banks and energy companies. Historically, stock markets have not performed better or worse during Republican or Democrat leadership. In fact, presidential election years have had slightly better performance than non-election years. Volatility has been higher in election years. It's tempting to wait until after the election to invest in stocks. Unfortunately, this behavior is common and usually hurts performance. We prefer to stay invested. If it seems like the markets have a lot on their plate for the rest of 2020, you're right, but this is almost always the case. It is often said that markets climb a wall of worry. When there is little to worry about, that can be trouble for the markets as prices may be too high. Consider an investment in the S&P 500 on the day Pearl Harbor was bombed, December 7, 1941. If you stayed invested for the next 10 years, you would have averaged a 16% annual return. Likewise, investing money the day Lehman Brothers went bankrupt, September 15, 2008, you would have tripled your money over the next 10 years. Switching to the medium-term outlook. Sadly, many investors like to sell low and buy high. The amount of cash on the sidelines now eclipses 2009 and is at almost $5 trillion measured by money market mutual funds. In 2009 and 10, the markets moved higher before many investors got back in. In March, April, and May, bank deposits went up $2 trillion to over 15 trillion. There's a lot of money that is all dressed up with nowhere to go until we get a coronavirus vaccine or herd immunity. It will be interesting to watch as this money makes its way back into the economy. Investor flows to and from stocks and cash is often a great contrarian indicator. A lot of investors get it wrong. They go to cash when they shouldn't be, and they cycle back into stocks once the market has already rebounded. The mountains of cash on the sidelines is a result of government stimulus and some investors nervously selling earlier this year. There's an old quote, it's tough to make predictions, especially about the future. Historically, when there's a large amount of cash on the sidelines, investors start to get back in once the storm clouds clear. Usually the markets have moved a lot higher once this happens. It's quite possible that the post-COVID-19 recovery could be amplified by the large amount of return-chasing behavior that almost always follows market corrections. While there are certainly risks on the horizon, we are optimistic that the good outweighs the bad. For those with a time horizon greater than the next year or two, patience may be rewarded. My team at Frazier Financial Advisors would like to say thank you for the continued support. We value the relationships we have formed with our clients. Referrals are the main way a new client hears about us. We would love to help your family, friends, and coworkers who are seeking financial advice. Have a great holiday weekend.